you're like me, you are a reader in theory, but not so much in action. Life is just so busy, and if you get a few minutes to curl up with a good book or pop in the AirPods for Audible, you want to actually relax with something light and easy. You want to whisk yourself away to another time in another place. The last thing you want to do is do some homework or have something heavy to think about, especially if it's something that you really have to pay attention to. This is why I created the Finlightenment Off the Record Book Club, where I do the reading so you don't have to. Once or twice a month, I'm going to give you a summary of a personal finance or a mindset book. Books that are really popular, that you've heard about, maybe even put on your own TBR list. I'm going to review all the high points of them, give you an easy to understand summary, and even share how I've seen the ideas play out in real life from my 15 years as a financial consultant. So sit back, relax, while I drop some knowledge on you from our friend Morgan Housel. So today's book is a big one, probably the most recommended finance book of the past decade, and it's called The Psychology of Money by Morgan Housel. It was published in 2020. And here's the twist that makes this book different from practically every other finance book that you've heard of out there. There's almost no math in it. Woohoo, am I right? No spreadsheets, no here's how to build a 3-fund portfolio. Housel's whole argument is that doing well with money has very little to do with how smart you are or how much income you make. And it has everything to do with how you behave. So over the next half hour or so, I am going to break down Housel's primary lessons about how to truly become wealthy. Lots of good psychology and mindset work in there, as well as some really cool economics and investment facts to back it all up. So if you're one of those people who likes to take notes, never you fear, I have put together a little review sheet, and you can download it in the comments or the description below. It's going to have the high points that I'm about to go over, so all the notes will be there for you. So grab your coffee, maybe grab that laundry basket and start folding or get those dishes going, because we all know you're multitasking right now. And honestly, if I could, I'd be doing that too. Let's get into it. Here's Housel's truth bomb number 1. Nobody's crazy. We're just playing different games. Housel starts here. No amount of reading about significant life events like the Great Depression will ever give you the emotional scars of someone who actually lived it. You can study it, get 100 on the exam, and you'll still see the world through a completely different lens than someone who is truly there. There's a great line in the book from investor Michael Batnick. Some lessons have to be experienced before they can be truly understood. And here's the research behind it. Economist Ulrike Malmendier and Stefan Nagel, sorry if I messed up those names, dug through 50 years of consumer finance surveys and found that your lifetime investing decisions are anchored almost entirely to what happened to you in your generation, especially early in your adult life. If you grew up during a period of high inflation, you probably will avoid bonds for the rest of your life, even when they'd help you. Grew up when inflation was calm, then you might lean into them. And their conclusion is blunt. This has nothing to do with intelligence, education, or sophistication. It's just the dumb luck of when and where you were born and what was going on in the broader economy during that time. Now, Housel goes deeper, though. He explains that the money rules that you live by right now were written by a kid. Not you today, you at 7, at 11, at 19 sometimes, watching how your parents and everybody around you reacted to money, absorbing lessons you didn't even know you were absorbing, and then carrying those rules forward as if they were permanent laws of the universe. Except the world that your parents built those reactions in doesn't exist anymore. Interest rates are different, jobs are different, the tools are different. You're navigating today's financial world using an owner's manual written from a completely different vehicle. This isn't groundbreaking information. It's very clear to almost everybody out there that we are products of our childhood experiences. But most people do not realize how deep those beliefs and habits are when it comes to money and how damaging they can be to your long-term financial success. I have hundreds of stories that I could share about this one, but the one that jumps to the front of my head every single time I think about this is my own story. Growing up, I never knew anyone who was anything other than a worker bee. They got jobs, they showed up every single day, they gave their best, they got their 1% to 2% raises, and they stayed there until retirement, and that was that. No one ever moved up the corporate ladder, no one became a manager, no one became an executive. I internalized that wasn't for people like me. As I started my career, I undervalued myself. When I started jobs, I never negotiated my salary. I always gleefully accepted the first offer because it was more than I'd ever thought I'd be making. It was a few years into working when I was chatting with some of my friends, my coworkers, about their paychecks that I suddenly realized I was dramatically underpaid. Even then, it took years before I had the courage to bring it up to management to correct that. Even beyond that, when I looked at jobs to apply for or opportunities to move up within the company to management roles, I never seriously considered them. I was limiting myself based on this false belief that that life, that role, that responsibility, that level of income wasn't for someone like me. Once I began my mindset journey and explored my own personal story, my own social conditioning, and my own identity contracts, I began to truly see how I had limited myself and how much I had missed out on because of that. Now, I'm thankful that I learned this lesson, but man, I really wish I had done it years earlier. It would have made a big difference in my long-term trajectory. This is why Housel says something that a financial advisor doesn't usually get to say out loud. Nobody makes crazy decisions with money, because what seems crazy to you and me might make perfect sense to somebody else based on the lessons that they learned growing up in their family and during the economic era that they primarily experienced as they got started in the working world. The guy who won't touch the stock market isn't an idiot. He's reacting to a story that his own life taught him. The day trader isn't reckless. He's playing a totally different game than the guy trying to retire at 65, even though they might be buying the exact same stock on the exact same day at the exact same price. Keep that info in your pocket because we're going to come back to it later when we talk about stock market bubbles. Here's Housel Truth Bomb number 2. We're all newbies at this. Quick reality check, and it stopped me cold the first time that I read it. The entire idea of retirement as something that you're entitled to is maybe only 2 generations old. Before World War II, most Americans worked until they died. That was the whole plan. The first ever Social Security check was cashed by Ida Mae Fuller in 1940 was for $22.54, about $416 in today's dollars. It wasn't until the 1980s that the average Social Security check topped $1,000 a month adjusted for inflation. Yet so many people want to treat Social Security as their primary source of income in retirement. And everyone used to have a pension, a phrase I've heard in nearly every client meeting, is wildly exaggerated. In 1975, only a quarter of Americans over 65 even had pension income, and for that lucky 25%, it was only 15% of their household income. The 401k law didn't pass until 1978, and accounts didn't really start until 1981. The Roth IRA didn't exist until 1998, which means it's only 28 years old. So here's the thing that really clicked for me. The beliefs your parents and grandparents handed down about saving and investing were formed with information that is now decades out of date. We have more tools, more access, more knowledge than any generation before us. But a lot of us are still operating on inherited beliefs built for a world that no longer exists. When you feel behind, or like everyone else got a manual that you didn't, good news, there is no manual. Good news, nobody else had one either. We are all winging it on something barely older than a microwave. This makes me think about a meeting that I had with a young man just starting in his first job after graduating college. He was anxious to get enrolled in his employer retirement plan ASAP. He talked about how his parents were in trouble because they didn't save much for their own retirement because they had to help support 2 different grandparents, one on each side. He was angry that his grandparents had not done a better job saving for their own future, rather than leave that burden on his parents. Now he looks to the future and sees that he will likely be supporting his parents too. We talked about how the world has changed, and everyone usually tries to do the best that they can given what they have available to them. In reality, his grandfather was almost 55 when 401ks became available. He didn't work at a big company, so he didn't even have a pension as an option either. Given that, how could he have been expected to even know how to save? His only option would have been his bank for his savings account. And given that he was born before the Great Depression, the lessons that his parents likely shared with him was not to trust banks. Put in that perspective, the picture looks very different. Okay, Housel Truth Bomb number 3. The goalpost never stops moving. And definitions matter more than you think. There's a story in here I think about constantly. At a party, 2 famous authors were talking. Kurt Vonnegut tells his friend Joseph Heller that their host, who is a hedge fund manager, made more in a single day than Heller made from Catch-22 in its entire history. Heller's response? He had something the host would never have. Enough. And then there's that darker mirror of the same idea, Bernie Madoff. Before the Ponzi scheme, Bernie Madoff ran a completely legitimate, wildly successful trading business, pulling in $25 to $50 million a year legally. He was by all measures extremely wealthy and successful. But he still built a massive fraud on top of it. Not because he needed the money, because even the multiple millions he had wasn't enough for him. Housel's line here is that in the whole chapter in one sentence, and I want you to actually think about this, maybe even write it down. The hardest financial skill is getting the goalpost to stop moving. He walks through this with a baseball example. A rookie earning $500,000 a year feels rich until he looks at his teammate's $43 million contract. Then that guy looks at the hedge fund managers making $340 million a year. Those guys look at the ones making $770 million. Everybody eventually looks at Warren Buffett. whose net worth went up $3.5 billion in 1 year. Buffett could look at Jeff Bezos, whose net worth in 2018 rose more per hour than that rich rookie made in an entire year. There's always a bigger number. There's always someone one rung up from you making you feel poor. Housel's point isn't don't want more. It's that an appetite for more that never gets satisfied will push you past the point where money is helping your life into territory where it's actively costing you your reputation, your relationships, your peace, your freedom. Things that are never worth risking for a number that was never going to feel like enough anyway. Defining enough is critically important, but so are other definitions, such as, what is happiness for you? So many people say that they would be truly happy if they had more money. But money in itself is nothing. If you had $1 billion on a deserted island, you're not going to be happy. Money only has value to you for what it can give you. And Housel believes that money's greatest intrinsic value is that it gives you control over your time. The highest form of wealth is waking up every morning and saying, I can do whatever I want today. I cannot stress enough the importance of definitions in your own journey to financial success. What would enough look like for you? What would a truly happy life look like? What is your definition of financial success? When would you say that you've accomplished it? One time I met with a woman in northern Maine to talk about her retirement plan. She was in her late 60s and had a total of about $100,000 saved in her 401k retirement plan. She had another $20,000 in cash for emergencies. Other than that, the only income she had was Social Security. I was prepared for this to be a really difficult meeting. But when we met, she brought a detailed budget in, along with a little potted plant that she brought in to give me, which was so incredibly sweet. And based on her budget, which, trust me, I picked through with a fine-tooth comb because I really wanted this amazing woman to be fully prepared for anything. But based on that budget, she was going to save about $300 a month from her Social Security payment. Her savings account was going to go up $300 a month while she was living only on Social Security. She lived very modestly in a small house, completely paid off. She was almost off the grid entirely. She had hobbies that she loved, which were very affordable. She had a strong social network. She had a loving family. She was truly one of the happiest people I've ever met. Now, she was only retiring because she wanted more time to volunteer at her church. The reason she scheduled that meeting with me wasn't even to look at her retirement plan, although she did like that second set of eyes. It was to make sure her beneficiaries were updated. Now, later that week, I was meeting with a doctor, also in his late 60s, with retirement balances around $4 million. His meeting was very different. Based on his budget, he was spending approximately $300,000 a year after taxes. He had a complex life with multiple homes, expensive hobbies that he wasn't willing to cut back on, and supporting several people that he had committed to. Based on all of this, he was not going to be able to retire for at least another 10 years, and honestly, probably longer. He was very stressed, frustrated, and angry that this is where he found himself at this point in his life. Now, based on these two people, who was truly successful? I think it's pretty clear that it was her. And it's mostly based on the fact that she had defined happiness and success for herself and then built that life within her means. Now, that, to me, is the true definition of wealth. Housel noted a study that was done by Carl Pillemer, where he interviewed 1,000 older Americans who were reflecting back on their lives. Not one of them said, I wish I'd bought a nicer car, a bigger house, more stuff. Instead, they valued relationships with family and friends, meaningful work in their lives, making an impact in their communities, and having time to pursue hobbies and passions. Think about this as you create your own life goals. Think about what you would be proud of, thankful for, looking back when you're on your own deathbed. Housel Truth Bomb number 4, the not-so-secret to success, compounding. Warren Buffett compounded his money at roughly 22% a year. Jim Simons, who ran the hedge fund Renaissance Technologies, compounded his at a jaw-dropping 66% a year, 3 times Buffett's rate. And yet Buffett is worth roughly 4 times as much as Simons. Why? Buffett started investing at age 10. Simons didn't get going until age 50. Housel actually calculates what Simons would be worth with Buffett's 70-year runway at that same 66% rate, and the number's absurd. Tens of quintillions of dollars, more money than exists on this planet many times over. Now, the lesson isn't be a genius investor. It's that time in the market does more heavy lifting for you than skill in the market. Good investing isn't about hitting the highest returns. Those tend to be one-off flukes that you can't repeat. It's about earning pretty good returns you can actually stick with for the longest possible stretch of time. That's when compounding stops being a formula and starts being magic. This is exactly why getting money and keeping money are 2 completely different skills. Getting money takes risk-taking and optimism, while keeping money takes the opposite: humility, a little fear, frugality, and honestly accepting that some of your success was luck, which means it's not guaranteed to repeat. Our survival mentality is the whole game here, because survival buys you longevity, and longevity is what lets compounding actually do its thing. Housel Truth Bomb number 5, play survival, not just offense. So how do you actually build that survival mindset? Housel gives 3 ideas. 1, aim to be financially unbreakable, not just high returning, meaning nothing shakes you from your long-term plan. Counterintuitively, unbreakable is how you get the best returns because it means you're still in the game when the rare, big compounding wins show up. 2, plan on the plan, not going according to plan. You plan, God laughs, right? The best plans build in room for a worse than expected outcome, a frugal budget, flexible thinking, a loose timeline, anything that lets you live happily with a range of outcomes instead of demanding one precise number. And 3, have a barbelled personality. Optimistic about the long run, paranoid about anything that could knock you out of the game before the long run arrives. Housel actually applies this literally to his own money, and I love how concrete he is about it in the book. He keeps one side of his portfolio genuinely boring and safe, and the other side genuinely risky. It may sound inconsistent, but the safe side is there to catch him if the risky side plummets, and the risky side gets the time it needs to recover because the safe side is paying the bills in the meantime. It's not be cautious or be bold, it's both on purpose at the same time. He calls the resulting worldview sensible optimism, a belief that the odds are in your favor over time, even though the road in between could include some real misery. And then there's that stat that backs it up. Since 1980, 40% of the stocks in the Russell 3000 lost at least 70% of their value and never recovered. Yet the index itself is up more than 73-fold over that same stretch, driven by just 7% of the companies in it. Tails drive everything. You don't need to pick the winners. You just need to not get wiped out badly enough that you're not around when the winners show up. There's a great pilot analogy too. Flying is hours of boredom punctuated by moments of sheer terror. So is investing. Your success is decided by how you handle the terror, not the years on cruise control. Even Peter Lynch, one of the best fund managers ever, said if you're terrific in this business, you're right 6 out of 10 times. Buffett has said most of his fortune came from about 10 stocks out of the 500 or so he's owned in his life. Charlie Munger's response, remove Berkshire's handful of best picks, and the track record is pretty average. That last one matters because of what it does to your self-image. We watch our role models' highlight reels, and we forget that those wins came from a tiny slice of their total decisions, which quietly makes our own losses feel like proof that we're doing something wrong. We might just be right and wrong about as often as the masters are. They were bigger when they were right. Doesn't mean that they were right more often than you. Housel Truth Bomb number 6. Wealth is what you don't see. This might be the most quotable part in the book, so let me lay it out straight for you. Wealth is what you do not see. It's the car not bought, the upgrade declined, the watch left on the store shelf. When most people say, I want to be a millionaire, they usually mean they want to spend $1 million, which is the literal opposite of being a millionaire. Rich is your current income. Visible, obvious, easy to spot. Wealth is hidden. It's the income you didn't convert into stuff. Its whole value is the options it gives you that you haven't cashed in yet. And here's the part that actually matters for your bank account. Building wealth has almost nothing to do with your income or investment returns and everything to do with your savings rate. You can have a huge income and never build wealth if you can't save any of it. You can have a modest income and become genuinely wealthy with a high savings rate. That's the whole equation. And it's the one lever that's entirely in your control. No market return can promise you that. Now here is Housel's sneaky good insight on why people don't save even with decent incomes. Spending beyond a basic comfort level is mostly ego dressed up as a purchase. Look what I have. Look how well I'm doing. One of the most powerful ways to raise your savings rate isn't a raise at all. It's increasing your humility. Savings is the gap between your ego and your income. Quiet that ego and the gap gets bigger on its own. Now here's where I want to push back on Housel a little bit because I don't fully agree with him on this next part. He argues that you shouldn't even need a goal to save toward. Just save for saving's sake because it buys you flexibility and the ability to pounce when a good opportunity shows up. And look, I get the spirit of it, but in my experience, people stick with saving far better when it's tied to something they truly want. I prefer specifics, but even a fuzzy general something would work. Totally goalless savings Works great in a book, but in real life, most people need a why, even a loose why, or the motivation fades. So take that one with a grain of salt. Housel Truth Bomb number 7, reasonable beats rational, aka emotions trump numbers. Housel believes that we shouldn't aim to be coldly rational with money. Aim to be reasonable. Why? Because rational, on-paper, optimal strategies fail constantly in real life. Not because the math is wrong, but because no human can actually stomach them. There's a Yale study on a leverage strategy that beats buy and hold by 90% over time. If you can survive potentially losing everything that you own more than once and then getting back in anyway. Brilliant on paper, but in real life, nobody's nervous system can do that. It's not reasonable, even though it's rational. The emotional turmoil is too strong for even the best return numbers for people to actually stick with it. Meanwhile, the historical odds of making money in the US markets, about 50-50 on any given day. 68% over a year, 88% over 10 years, and so far, 100% over any 20-year stretch. Anything that keeps you in the game long enough to reach that window has a real edge. Which is why it's worth falling in love with your strategy, boring as that sounds. Loving it is what gets you to stick with it through the ugly years. When thinking about risks, no matter what the data says on paper, there are some risks so big that they are not worth taking even if the odds are in your favor. Housel explains this with a Russian roulette example. If someone said, would you play Russian roulette for $1 million? Would you? On paper, the odds are great. 6 chambers in the gun, 5 empty. But would you do it? Most would say no, because if you are wrong, if you get that one chamber that holds the bullet, the loss is so devastating that it's not worth the risk or the return. People behave similarly with investments. There, like we said earlier, are investment strategies that have such extreme volatility that you could lose almost everything. But if you stick with it long enough, it can generate a significant return. Most people would not do it because they could not stand the psychological stress of frequent losses of almost everything. They would much rather have a lower return with a more reasonable chance of loss. There's a great line from Stanford professor Scott Sagan that I think about a lot. Things that never happened before happen all the time. History is basically a highlight reel of surprises, and yet we keep using it as a map for the future. It helps us calibrate expectations, but it's not a forecast. And investing itself isn't really a hard science either. It's a massive group of people making imperfect decisions with limited information about things that will massively impact their well-being, which makes even smart people nervous, greedy, paranoid. Physicist Richard Feynman once said, imagine how much harder physics would be if electrons had feelings. Well, investors have feelings, and that complicates everything. During my time as a financial consultant, the single most common trade I saw that people would make was the day after a major stock market drop. People would contact us to sell their stock-based mutual funds. Many of them were index funds. Their rationale, I don't want to lose everything. Sell now, stop the bleeding, and then I'll buy back when things get better again. On paper, that is absolutely the worst move to make. I could sit there all day and show people all the historical market return data, the trends, talk about the statistical likelihood of an index fund dropping to 0 and what that would mean on a bigger level, basically global catastrophic loss, and why most of them would still make the trade. Why? Because their emotional reaction, their fear, overwhelmed their ability to think rationally. Inside everyone, there are 2 investors, that emotional investor and the intellectual investor. We spend all of our childhood building up that emotional investor based on what we see, hear, feel, and absorb from others around us and our broader environment. There is no thoughtful review of this information, it's just accepted as truth. Once we get old enough to start reading up on finance, listening to different podcasts, or exploring things on our own, we start to build up our intellectual investor. Eventually, the intellectual investor dominates the emotional, even though the emotions still rear their ugly heads at times. For many, though, the emotional investor is still driving the bus. And sadly, when it comes to money, decisions based purely on emotion are almost always wrong. Housel Truth Bomb number 8. Room for error is the whole game. If there's one phrase to take from this book that's a little bit different from other books, it's margin of safety or room for error. Margin of safety really means that you should build your plan looking at a range of possible outcomes, including some good ones and some bad ones. It means looking out at your long-term plan and saying, what is the lowest level of return I can get and still make my plans work? It doesn't mean that you shoot for that lowest level of return. You obviously target something that's much more realistic and then maybe even consider a stretch goal. But by considering a range instead of one set estimate, it allows you to consider that gray area of potential returns between your goal rate and your lowest possible rate as an acceptable range of options. It's the only reliable way to navigate a world governed by odds instead of certainties, which is really every part of life involving money. As humans, we crave precision. We want a set retirement income level or a known investment return or an exact retirement date. But the honest answer to what will the market average over the next 10 years is not one number, it's a range. Margin of safety lets you operate in that gray area instead of focusing on one black and white estimate. Now here's a gut check worth asking yourself. Can you actually, emotionally, not just technically, sit through a 30% drop in your portfolio without doing something that you regret? There's often a gap between what you can survive in theory when you're talking with your advisor and what you can survive in reality when you're lying in your bed at 2 a.m. after hearing the news that the market has plummeted that day. That truthful reaction should guide your asset allocation and risk tolerance decisions. Because volatility is the price you pay for returns, which brings me to one of my favorite reframes in the whole book. Think of volatility as a fee, not a fine. Consider this analogy. A Disney park ticket for a family of 4 costs a small fortune. You don't have to pay it. You could stay home for free or you could go to another less expensive park. You have options, but you usually get what you pay for. Here's the part that really makes the whole thing click for me. You get to the park. The kids are hot and cranky by 2 p.m. and they want to go back to the hotel pool. And you say, absolutely not. We paid a fortune for these tickets. We are staying all day and we're going to have fun. And you know what? You do. Everyone ends up having a blast. Market volatility works the same way. It's not a punishment for doing something wrong. It's the entry fee for returns that are better than what cash or bonds pay you. The trick isn't just tolerating the fee. It's convincing yourself that the fee is worth it so you don't bail early and miss the fun of the whole day at the park. Now remember those people that I talked about earlier who made that panic sell decision after the stock market dropped, even though all the data said that that was the wrong decision for them? Well, what I noticed is that when I met with people who were properly diversified into a mix of funds that reflected their proper risk tolerance, even though they still felt the fear after a stock market drop, they were far less likely to make that emotional trade. Why? Because they had built a reasonable plan that included the likelihood of market drops. They were prepared for this market volatility, and these people were far easier to talk off the ledge before making a potentially devastating trade. Housel Truth Bomb number 9. You are not who you will be in 20 years, just like you are not the person you were 20 years ago. Psychologists call it the end of history illusion. We're all very aware of how much we've changed in the past, but we badly underestimate how much we're still going to change into the future. Only 27% of college graduates end up working in a job related to their major, even though they put all that time and effort into it. Even Warren Buffett in 2006 said that his eventual successor needed to be genetically programmed to recognize and avoid serious risks, including those never before encountered. Even though his fund is one of the most growth-oriented funds ever, that wasn't the priority. Protection was. Housel's fix for this? Stop thinking of your life as one long 80-year runway and start thinking of it as 4 distinct 20-year blocks. You're going to be a genuinely different person in each one, different priorities, different risk tolerance, different definition of a good life. Planning as if the 25-year-old version of you and the 65-year-old version of you want the same things is where a lot of financial regret comes from. So here are 2 practical takeaways. Avoid the extremes. Don't sacrifice every bit of today for a future self you might not even recognize. And don't ignore the future because today feels urgent. Also, let go of those sunk costs. They're gone. Don't stay anchored to a decision that doesn't work for you because you put money into it or time. The sooner you make changes that recognize who you are now, the better it will be for you. The sooner your money and your energy can get back to compounding towards who you actually are now. Believe it or not, my best story for this lesson is from a friend who's an excellent financial advisor herself. She was very successful in her early career and she followed her own advice by front-loading her retirement. A lot. She maxed it out every year and ended up with this amazing retirement fund very young. Then she fell in love, got married, and wanted to buy a house. But all of her money was tied into her retirement account, which was very limiting in terms of how much she could access for a home down payment. She was so angry with herself because she knew better. And now she's retirement rich and cash poor, and she couldn't make a move on the home that they wanted. Now, a better plan is to plan out all of your goals within that 20-year block in 2 time horizons. Short term, less than 3 years. Intermediate, 3 to 7. Long term, 7+. Then make a plan to work towards all of them at once. Housel Truth Bomb number 10. Different games, same stock price. This chapter explains bubbles in a way that makes sense. And it loops right back to the first segment's big idea that nobody's crazy, everybody is just playing a different game. Housel's question was, how much should you pay for a share of stock today? But the answer depends entirely on who you are. A 30-year investor should be pricing in 3 decades of cash flow from the company. Someone cashing out in 1 year watches only this year's product cycle. But a day trader's honest answer is who cares? They just need the price to move favorably for a couple of hours. The problem? All of these people are bidding on the exact same share at the exact same price for completely different reasons. When an asset gets momentum, short-term traders pile in, reasonably from their point of view. But that pulls in more traders, which shifts the entire market's price setters from long-term investors to short-term ones. That's a bubble. It's less about valuations getting crazy and more about time horizons getting shorter and shorter as more short-term money floods in. The Cisco example from 1999 says it all. The stock hit $60, valuing the company at $600 billion, a price implying, per economist Burton Malkiel, that Cisco would become bigger than the entire U.S. economy within 20 years. Nobody seriously actually believed that math. The day traders didn't care, though. They were selling before it mattered. But long-term investors who saw everyone buying at $60 assumed that the crowd knew something they didn't and got pulled into a game that was never designed for them. By the way, as of 2020, when this book was released, Cisco's stock hit a price of $49 per share as the high. There's a nice antidote that Housel offers here too. Write yourself a money mantra. Something like, I'm a patient, long-term investor, confident in the world's ability to grow over the next 30 years. Sounds a little corny, but the point is real. A clear statement of who you are as an investor lets you tune out the news that was never meant for you in the first place. If you never pay attention to the noise, then it has no chance of talking you into making a bad decision. All right, as a financial consultant, every single client comes in and asks you what to buy. What's hot right now? What's going to explode? Where should they put their hard-earned money and watch it soar? As a financial consultant, we all know to avoid answering that question at all costs because honestly, it's a terrible question. As Housel points out, this isn't about picking the winner because the winner is the entire stock market, aka broad-based index funds. The winning strategy is to save and stick with it for the long term. Most millionaires become millionaires using those standard investments with that basic strategy. It really is that simple. But another reason to dodge that question is that we need to pick an investment strategy that works for you with your specific time horizon and your risk tolerance. An investment that you're going to stick with to get your needs met, whatever they might be. So that pick a winner mentality, it's time to let it go. Most people think investing success comes from finding the next Amazon. Housel says that almost never creates wealth. The real superpower is simply staying invested long enough for compounding to do its work. And that's why the next lesson matters so much. Housel Truth Bomb number 11, why pessimism always sounds smarter. This is the last big idea and one of my favorites. Why does doom always sound more credible than good news? It's evolutionary. Tell someone everything's going to be fine, they shrug it off. Tell someone they're in danger, you have their full attention. Kahneman's research backs this up. Organisms that treat threats as urgent survive better than the ones that are chasing opportunity. It's wired in. Which is why a 1% market drop gets blasted everywhere, while a 1% gain barely registers, despite our lifetime showing almost unimaginable overall progress in the stock market. Pessimists also tend to extrapolate straight lines into the future without accounting for the fact that markets adapt. In 2008, an environmentalist projected the world would simply run out of oil. Instead, prices rose, fracking got invented, efficiency improved, and today's production is actually higher than the peak everyone feared back then. Optimism asks people to believe something new and completely different could exist, and most of us genuinely struggle to picture that, which is exactly why the Wright brothers' first flights were dismissed by eyewitnesses as a magic trick for years, and why the Washington Post confidently predicted in 1909 that planes would never haul cargo 5 months before the first cargo plane took off. Progress happens too slowly to notice, but setbacks happen too fast to ignore. Overnight tragedies are common, while overnight miracles basically don't exist. And pessimism is easier to sell as a narrative anyway. Bad news is fresh and immediate, while an optimistic case requires looking back across the long, forgettable stretch of gradual progress. There's a strange, wonderful twist here, too. In a 2004 interview, physicist Stephen Hawking, paralyzed since age 21, was asked if he was always so cheerful. His answer roughly, once his expectations dropped to zero, everything after felt like a bonus. Lowering expectations doesn't make you a pessimist. It might be the most reliable path to feeling pleasantly surprised, which ironically is its own quiet form of optimism. And this same wiring is exactly why appealing fictions work on smart people. When the stakes feel high enough, we'll believe almost anything that promises the outcome we want. That's how an actively underperforming corner of the mutual fund industry still holds close to $5 trillion, because everyone wants to believe that this one manager is the one who is the next Warren Buffett. Once you want something to be true, your brain quietly starts collecting only evidence that agrees with you and ignores the rest. All right, let's wrap this up. If you only remember 5 things from this episode, make it these. 1, nobody's crazy with money. Everyone is just reacting to their own unique history and playing their own private game. 2, wealth is invisible. It's the stuff you didn't buy, not the stuff you did. If you want more wealth, ditch your ego that is telling you to buy more, spend more, get more stuff. Because the less you spend, the more you save. And number 3, savings rate beats income and beats returns, full stop. And it's the one lever you entirely control. Number 4, room for error isn't weakness, it's the whole strategy. It's what lets you survive long enough for compounding to work its magic. And number 5, know your own time horizon and don't let people playing a different game talk you into their price. The goal was never to get rich. It's to get and stay unbreakable. Because unbreakable is what actually lets you get rich slowly over the only timeline that ever really works, your whole life. That's The Psychology of Money by Morgan Housel. Go pick it up if you want the full 250 pages, but if you just wanted the version you can absorb on your commute, hopefully I did the reading so you didn't have to. I'm Tammy Kayada. This has been the Finlightenment Off the Record Book Club. Next time, we're going to dig into Stephen Covey's 7 Habits of Highly Successful People. The gems of wisdom from this book are incredible and go across all different avenues of life. Until next time, keep learning, keep growing, and keep building the life you actually want.